Welcome back. It's time now for Hot Picks, and today we are zeroing in on the retail sector. Our next guest has O'Reilly Automotive as his top pick, pointing to steady growth with expansion ahead for the auto parts retailer. So joining us now is Stephen Zaccone, senior analyst and equity research at Citi. It's great to have you join us. Thanks so much.
Thanks for having me on, Lindsay. Great to be here.
Yeah, so O'Reilly Automotive, we'll start with that. You say this company has been the leader of consistency among the auto parts retailers.
Yeah. Consistency in the auto parts retail space, one of the best executors in all of retail, right? Auto parts retail is a great defensive subsector in the retail backdrop. It's a needs-based category, right? In the midst of kind of higher interest rates and consumer, tightening budgets, you're going to have to continue to repair your existing vehicles. So this business really serves that kind of sweet spot. And you think about the opportunity for market share gains, they've been the big market share gainer relative to some of the independents and some of the other players in the space. But O'Reilly is really best in class when it comes to the auto parts retail segment.
Is there any downside risk to your buy rating on this company?
Yeah, I mean, we're in the midst of a very macro tape, right? Like obviously, oil prices are up, right? What does that do to the consumer? We've published extensively here about, gas prices and the risk. Like we actually had a bunch of companies at our conference last week in Miami. We had 60 in total. O'Reilly was one of them. And, there's a lot of uncertainty, right? The key factors are, how long does the conflict last, right? We've seen this initial shock. We're really paying attention to what happens with consumer traffic trends and spending. So that is a risk if the consumer takes a leg down. But when you think about who are the more defensive businesses, auto parts is a relatively needs-based transaction. So I think they would be one that screens more defensively relative to some other discretionary purchases in retail.
Next hot pick is one I think a lot of people are familiar with, and that is Home Depot. What is it you like about this company right now?
Yeah, I think, if we start with the market backdrop, right? Like we've had a pullback in a lot of the housing exposed names within the last, month to 2 months. There was a lot of optimism coming into the year that we're going to start to see rates come down. I think you look at the opportunity here with the sell-off in this macro tape. This is your opportunity to lean into some of the better quality businesses that have a little bit more cyclical exposure. I'd put Home Depot right up there, right top of the list. You think about home improvement spending has a lot of pent-up demand for the next couple of years. It's been very difficult to call the exact timing, but we've been in this period where, housing turnover has been weak. People have been delaying some of the spending on the home. As you start to see housing turnover improve at some point in the next couple of years, Home Depot is really the best way to play that in our view. You've got the exposure to the DIY customer. You've got the exposure to the large pro. They're doing some acquisitions to kind of build their capabilities. So, I think you're definitely kind of defending the weakness here in a Home Depot if you've got a longer term time horizon.
It's so interesting. Like I'm assuming some of the key risks for Home Depot, like for this company, is in correlation really with the housing market and how the housing market is doing in Canada. Is that right?
Yeah, I mean, U.S. more importantly, but yes, rates matter for housing turnover, right? And what matters, housing turnover really drives people doing large project activity, and that's kitchens, baths, flooring. That's the area of the market that's been, weak. We've seen engagement get better in the home, but you really need, the unlock of kind of turnover for some of that project activity to happen. So, I think great business in terms of protecting profitability. If sales come in a bit weaker, there's no real concern about margins being at risk at a business like this. It's just top line environment could be a little bit weaker, but I think that's a buying opportunity in the longer term view of the business.
For sure. Okay, your last pick is Tractor Supply Company. What is it you like about this one?
Tractor's a unique one, and it's topical in the sense of oil prices going higher. If you're looking for retailers that tend to be a beneficiary from higher inflation, Tractor hits that. They sell some oil-based products, right? So think about lubricants and stuff of that nature. They have higher exposure to the domestic regions in the United States where you'd see oil production pick up, and maybe that helps the local economy. So that's a Texas and an Oklahoma. The other factor is, they really have a dependence upon commodity inflation. So think about corn, grain, they sell a lot of livestock feed. Those are leading indicators for kind of inflation in their business. The fact that oil has gone up tends to be a leader for commodity inflation as it relates to their business. So they look like a net beneficiary. Now, I think they're still a second derivative housing play. So you'd like to see housing turnover improve. They have exposure to the pet category, which feels like we're at a point that trend should start to improve in 2026. The last couple of years, sales have been weaker, but I think it's a good quality business. They've got great control over the operating margin from here, and it's another one where this weakness is probably a buying opportunity.
It seems as though, the retail sector as a whole has been pretty resilient to tariffs over the last year or so, absorbing those costs as much as they can too. We're starting maybe to see a shift in terms of consumer spending, like consumer pullback in the retail sector as a whole. I wonder if that concerns you at all for the sector moving forward.
The tariffs, we've been able to pass on some of the pricing, right? Mm-hmm. And we're probably at peak in terms of tariff pricing, second half of 25, really now first half of 26. And largely speaking, we've been able to pass it on to the consumer. We haven't heard a lot of retailers have margin issues, right? I think the concern for retail and the consumer now, you have a prolonged conflict in Iran. Oil prices continue to stay high. What does that do to the health of the low-income consumer? What does it do to the propensity for, consumers to kind of spend on big ticket goods? It's a difficult environment right now, because if we get a resolution tomorrow and oil comes back down, it's a several week phenomenon that kind of goes away, and you start to see a recovery in terms of consumer confidence. But if it lasts longer, it is something to monitor for the health of the consumer.
For sure. Okay, we'll leave it there. Steven Zaccone, Senior Analyst in Equity Research at Citi. Appreciate your time and your insight. Thanks so much for joining us.
Thank you.